Hello, welcome to Chapter 3, Audit Risk. Big picture as always at the start of these recordings. Consideration of audit risk is to a large extent assumed knowledge, as you will have come across this topic in F8. However, on the basis that it could be some time since you passed F8, maybe it's worthwhile important that you revisit the topic, as it regularly features in P7. At the professional stage, however, it is unlikely that you'll get many, if any, marks simply for providing definitions. That's what F papers are for, not what FP papers are for. You must have a good working knowledge, however, and understanding of key terms in order to be able to properly assess risks in a given scenario, which is what P papers are all about. It's giving practical scenarios for you to answer. An auditor must, as part of his assessment of a client's internal control system, consider the risk to which the client's business is exposed and the extent to which there may be some material misstatement in the client's financial statements as a consequence of not identifying and managing risk. Consideration of risk is an integral part of a modern day audit. There have been a number of articles in Student Accountant in the area to which you must read. So ACCA website, or if you've got your own copy, dig them out. So, okay, key terminology. Audit risk, what is it? Well, very simply, it's the overall risk that the auditor gives an inappropriate audit opinion in his report. In other words, he gets it wrong. So, issues an unmodified audit report when it should have been modified, etc. Why is this an issue? Well, if you issue the wrong one, then shareholders and others who will place reliance on your report in making economic decisions, i.e. investments or whatever, might suffer a financial loss, and therefore the ramifications could be enormous. Auditors do have big pockets, do have indemnity insurance. Audit risk is made up of three parts: inherent risk times control risk times detection risk. The auditor must assess the inherent risk and control risk, but remember, they can't actually influence that. They are what they are. The business has inherent risks. If it's an oil field in the North Sea or offshore in the Gulf of Mexico, by operating in the sea, clearly you've got weather issues. You've got what happens if the oil leaks and the risk of huge liabilities. Control risk, well, that's in a business where the company does what it does in trying to control through internal control systems, management delegation, segregation of duty, whatever, but there'll always be a risk that things don't quite work out. The one thing that you can try and sort out is an influence as an auditor is detection risk. You can do that. And what you try and therefore do is order your audit so that it becomes an acceptable level of audit risk. Okay. Now, what are the things? Well, inherent risk is the risk that there may be material errors or misstatements, doesn't have to be errors, or misstatements in the client's financial statements before giving consideration to any internal controls that may have been established. So, for instance, in a high-tech company, there is a high risk of obsolete inventory, i.e. stock, which if not recognised could result in material overstatement of both profits and asset values. Control risk is the risk that the client's internal control systems will fail to prevent or detect material errors or misstatements. E.g., if there's not an effective segregation of duties, then there is much higher risk of employee fraud. Because, even without colluding, it can go undetected. Detection risk is the one, as we say, that auditors can influence. It's the risk the auditor's test inquiries will fail to detect material errors and misstatements. Okay. So, for instance, the detection risk is always greater with a new client, because the auditors have less time to build up their knowledge and understanding of the client's business and their systems and the risks to which they are exposed. Detection risk is further broken down between sampling risk, which is getting your sample either too small, may not be representative, and therefore could result in the auditor reaching an invalid conclusion about their population. So sampling risk is getting the wrong output because your input has been wrong. Non-sampling risk is any other risk that might result in the auditor arriving at the wrong audit conclusion, e.g. if client management were to deliberately provide the auditor with misleading information and explanations. From an exam point of view, it's important not to confuse audit risk with business risk. Business risk is quite different. Business risk is the risk that a company will fail to meet its strategic objectives. Okay, business risk is to a large extent tied up with the fundamental accounting assumption of going concern, which we all do our accounts on without realising why we're doing it on that basis. But anyway, that's what it's about. Business risk may also be seen as made up of three elements: operational, financial and compliance. Some examples of are in front of you. It's important to note carefully the question requirement. In the exams, you need to work out and see which type of risk you're being asked to consider regarding a particular scenario. Make sure you get the right one. Okay. Quality control. Quality control is about how a company operates. It's to do with an individual audit engagement and looking at that business so that the firm as a whole reaches the right conclusion. Assumed knowledge F8 is quality control for audits of historical financial information. New to P7, however, is ISQC1. Quality control for firms that perform audits and reviews of historical financial information. Quality control is clearly seen by the examiner as being a very important area because I guess it affects the profession and how the company is audited, and to greater or lesser extent has pretty much featured in all exams to date. When considering ISQC1, note carefully that this should be applied by all professional firms, irrespective of their size. So I've seen a question asked about a small firm. They have the same responsibility towards quality as a large firm. Clearly there are different issues, but being professional, competent, etc., independent, are all the same whether you're large or small firm of accountants. Yes, and here we go. There was this question which I've seen before. People were totally dismissive almost of a small firm, and they basically couldn't produce quality work. That is not how you should answer a question. Okay, so there'll be quite a lot of things said in the scenario. ISQC1, what it's about? Well, there are 6 areas that together make up quality control. Another little list for you to learn. You need to know that there's leadership, ethics, client relationships, engagement performance, human resources and monitoring. What are these things? Well, we're going to quickly run through them. Leadership. The whole culture of the firm needs to be based on a recognition that quality is essential. The leaders need to make sure this happens and set a good example. Management must take responsibility. Ethics. The standard highlights the need to establish policies and procedures designed to ensure that the firm and its staff comply with all relevant ethical requirements. At least once a year, all staff should meet an independence requirement, for instance, and report any movements. Safeguards should be in place within the firm to guard against threats to any independence, i.e. you should rotate your engagement partner. Client relationships. Proper due diligence procedures should be carried out before accepting appointment to a new client, and that's, if you're a worldwide firm of accountants, part of the Big Four, that is quite difficult to do, but you do need to do it. It's a particularly important procedure relating to proper consideration of client integrity. You also need to consider money laundering implications. Professional etiquette should be applied, which means communicating with the professional advisor of the client at the moment, having first of all sought their permission, the client's permission to speak to the professional advisor. Engagement performance. The firm should establish policies and procedures to provide it with reasonable assurance that engagements are performed in accordance with professional standards and regulatory and legal requirements, i.e. the firm's quality, whether you're large or small, is maintained. The particular things you need to think about in doing quality is plan an audit, supervise an audit, and then review that audit. 3 very important things. 3 different stages as well of an audit. And in an exam you must work out which stage you're at. Are you at the planning, during the audit, the supervision, or are you at the review stage? Human resources. You need to have the right sort of people working in your firm to make sure that they're capable, they're competent and committed. Policies and procedures should cover recruitment, capabilities, career development, performance evaluation. These things are all important in quality control. Monitoring. The firm should establish policies and procedures designed to provide it with reasonable assurance that the policies and procedures are relevant, adequate, operating effectively, not just yesterday but also for tomorrow and the future. They have been complied with in practice, not just on a document, tick and bash. It is reality, and it's also been sufficiently and adequately documented. Okay, and there should be an ongoing consideration and belief in this process to make sure firm systems of quality control are adequate. That's called a cold review, but there's also something called a hot review, which is an internal review committee before the accounts are signed off. Okay, that's the end of that chapter. I'll see you in the next chapter, which is chapter 5.